The storm desk? Read the storm, book the roofs. The hail hits, you sign 20 replacements, collect a deposit on every one, and the bank balance looks huge. You feel rich. Then the crews tear off. The supplier invoices land, payroll runs, and that fat account drains fast. So which week was the truth? By the end of this, you'll know how to read 2 reports on the same storm. The cash report, what money moved. The accrual report, what you earned. One feels great on deposit week. The other tells you if the roof made money. Start with the 2 rules. Cash and accrual are 2 rules for when a roof job counts as revenue. Cash books income when the money lands and expenses when you pay them. Accrual books income when you earn it, when the roof is on, and expenses when you incur them, whether or not cash moved. A re-roof you finish in May and collect in August is May revenue on accrual, August on cash, same job, same dollars, 2 different months. The gap is wider in roofing than in almost any trade. Run one insurance re-roof through both and watch them split. Homeowner signs a $24,000 replacement after hail, $2,000 deposit in April. You install in May. The carrier's check clears in July. On cash, that's $2,000 in April, $22,000 in July, nothing in May, the month you built the roof. On accrual, it's 0 in April because the deposit is money you owe back as a roof, then the full $24,000 in May when the job is earned. July is just collections catching up. Cash trails the work. Accrual tracks it. Here's the deposit trap, the sharpest fork. Under accrual, a deposit is deferred revenue, a liability you carry until the roof that earns it is on. Under cash, it's income the day it hits the bank. After a big storm, you might collect deposits on 10 replacements in a week and feel flush. But nothing's installed. The material orders, dump fees, permits, and payroll are all still ahead. Spend that deposit like profit, and you get squeezed when install week hits. Now the part most owners miss. Your tax method and your management reporting do not have to be the same thing. For a growing roofer, they usually shouldn't be. You can file taxes on cash for simplicity and a deferral, while running your internal reports accrual style, so you can see backlog, receivables, and per job margin. Filing cash does not mean reporting cash. The IRS lays it out in Publication 538. Pick the tax method for the return. Pick the reporting view for the truth. You don't fully get to vote on the tax method. The main gate is the gross receipts test, a size cap on who can use cash. Under Internal Revenue Code, Section 448, if your 3-year average gross receipts stay under an inflation-adjusted cap, you can generally use cash. For tax years beginning in 2025, the threshold is $31 million, rising to $32 million in 2026. Most independent roofers sit well under that line. One catch, a controlled group can aggregate receipts and push you over. Here's where roofing diverges from a retail shop. Roofing is construction, and construction has its own rule. Internal Revenue Code Section 460 generally forces percentage of completion, recognizing income as a job progresses. On long-term contracts, any job not finished in the same tax year it starts. The relief valve is the small contractor exception. Pass the gross receipts test and expect the job to wrap within 2 years, and you're exempt and can defer the whole profit until it's done. For a re-roofer who closes jobs in days, this rarely bites, and the rules moved in 2025. The One Big Beautiful Bill Act, signed July 4, 2025, widened the door for residential contractors. For contracts entered into in tax years beginning after that date, the law expanded which residential contracts can sit outside mandatory percentage of completion, beyond the old 4-unit limit, and dropped an alternative minimum tax adjustment that used to apply. The upshot: if you do residential work that crosses tax years, your options to defer that income loosened. That's a conversation for your CPA, not a switch you flip yourself. Now the difference that hits the day you need someone else's money. Lenders, bonding companies, and buyers read your financials, and they trust accrual. Accrual statements, especially under generally accepted accounting principles, show real backlog, what customers owe you, what you owe suppliers, and whether you're truly profitable or just temporarily liquid. A cash statement can hide all of that. A fat bank balance that's really unspent deposits, with aging receivables nowhere on the page. Cash basis isn't wrong. It's just incomplete for outsiders. When a lender requires GAAP statements, revenue follows a standard called ASC 606, the Rule for Revenue from Contracts with Customers. It asks one question that matters to roofers: is the revenue earned over time or at a point in time? A single-day residential re-roof might be recognized at a point, when it's finished. A multi-week commercial membrane job is more likely over time. which looks a lot like percentage of completion. Don't let your software default decide this. A qualified accountant should make that call and document it, because lenders and auditors will test it. If you do switch tax methods, know this. It is a formal IRS filing, not a spreadsheet toggle. To change cash to accrual or the reverse, you file Form 3115, the application for change in accounting method. The piece that surprises owners is the Section 481A adjustment, a true-up, so no income gets counted twice or skipped. Move from cash to accrual, and you'll likely pick up your existing receivables as income. A favorable one can often spread over years. An unfavorable one may hit at once. That's a real cash consequence, and exactly why it's a CPA decision, not a setup wizard. Before you ask a CPA which way to go, clean the records first. The change is only as good as the books feeding it, because the 481A true-up depends on knowing your real receivables and payables on the change date. Reconcile every account, pull aged receivables and aged payables, list every open deposit against its job. Flag every job done but not fully billed, and every job billed but not collected. Match each open supplier invoice to a job number. Do this, and the change becomes a tax decision, not an expensive reconstruction. Insurance work has its own timing fight, so handle it separately. A carrier typically pays the actual cash value, the depreciated value of the loss, up front, and releases the recoverable depreciation, the held-back rest, only after the work is verified complete. So you install in May, bill the carrier and homeowner, then wait weeks on the release. The contract is what you earned, recognized on accrual when the roof is done. The claim payment timeline is a separate cash event, so track them apart. Don't confuse the homeowner's claim status with your invoice status, and remember the insurer decides coverage. That's not your call to make. Here's where RoofPredict fits and where it doesn't. None of this accounting works on a bad job file, and most roofing reporting pain is really record pain. RoofPredict pairs an estimated roof age range with storm physics modeled per home to flag which roofs a storm likely wore out. And it keeps your per-job records, change orders, and closeout notes in one place. That hands your bookkeeper clean source documents instead of scattered emails. It is not accounting software and not a CPA. It does not inspect roofs, diagnose damage, or decide coverage. Roof age is a planning range, not an exact date. Close the loop. Cash shows what money moved. Accrual shows what you earned. They agree on a roof's total profit and violently disagree on the month. A deposit is a liability until the roof is on, so don't spend it like profit. File the tax method your size and contracts allow, but run accrual-style internal books so you can see real margin and backlog. Switching means Form 3115 and a true-up, not a toggle. This is operations, not tax advice, so make the call with the CPA. Cash answers whether payroll clears Friday. Accrual answers whether the job made money. Read both.